So the one big beautiful bill act, right, is lengthy language there. But yeah, so really what that did was extend and make permanent a lot of the provisions that were previously in place already that were scheduled to sunset from the 2017, Trump's original tax bill. So it really just it kind of extended a lot of the key things in there. Probably what's most prevalent is the 100% bonus depreciation, which I know a lot of real estate investors were hoping for, were excited about. And so now that has been set at 100%. It's set permanently unless another administration change and they try to adjust that. But it's set at 100%. And the key indicator there, for those that are wondering, is the date.
Welcome to the Yacht Captain Investor Podcast. I'm your host, Scott Kidd, where every week we dive deep into conversations with real estate pros, business owners, and maritime professionals about their mindset and journey to success. Please help support us on our journey and our channel by liking, subscribing, and commenting below so we can help you in your journey to success. How you doing today? Scott Kidd, the Yacht Captain Investor Podcast. I have a friend of mine on, CJ Tarantino. How you doing today?
Great, Scott. Thanks for having me here. Excited to be on the podcast.
Appreciate you being here. For the people that don't know you, please just tell us a brief intro about yourself.
Yeah, so I run a CPA firm that is really specialized in working with real estate investors. So my background is I spent 10 years at large CPA firms, learning from some really seasoned CPAs throughout my career. And so kind of rose up through the ranks there, was, one of the higher end on billable hours, and then just kind of came to the conclusion, what if I applied that same effort and expertise into my own firm? And that's how I got here today.
Excellent. Well, it's a whole different ball game when you go on your own. I bet there was a pretty decent learning curve there too, huh?
Yeah, for sure. I mean, was definitely had the technical components down, but then now it's general business knowledge and all the facets of that, right? Like sales and marketing and things like that. So we're still sharpening up on that, but we definitely handle the technical components very well.
Well, that's all a learning curve as you grow. It just gets easier, and then some things get harder as you go, as you're trying to grow and scale. That's a whole nother ball game. And just wanted to ask you, because since you're real estate specific, I get this question a lot: is what are some of the benefits and what are some of the disadvantages of all the new round of tax in the, I guess, big beautiful bill they're calling it?
Yeah. So the one big beautiful bill act, right, is lengthy language there. But yeah, so really what that did was extend and make permanent a lot of the provisions that were previously in place already that were scheduled to sunset from the 2017, Trump's original tax bill. So it really just it kind of extended a lot of the key things in there. Probably what's most prevalent is the 100% bonus depreciation, which I know a lot of real estate investors were hoping for, were excited about. And so now that has been set at 100%. It's set permanently unless another administration change and they try to adjust that. But it's set at 100%. And the key indicator there, for those that are wondering, is the date is January 19th, 2025. So your property had to be acquired and placed in service after that date. So we have some clients that, purchased right before. Unfortunately, that 100% will likely not apply to you. But that's kind of the key indicator there.
So you would probably still fall under the 40% or the 60%? Is that what it would be?
Yeah, so you'd still be under that previous tax law. And so, yeah, that would be, a little bit unfortunate based on the timing. But, now if you're planning now, right now it's, right at the end of August, we got 4 months or so left in the year if you're strategizing, which is a great time to do on a real estate investment as part of your tax plan, you would be eligible for that 100% bonus depreciation. And the really nice part in this bill is that there's no scheduled phase down like there was previously. Like you had touched on, 60%, 40%. Every year it kind of declined by that 20%. In this case, it's 100%.
Very nice. I know I've personally reaped the benefits of that. That's been very helpful to me, and as it was kind of a learning curve there. That's one of the big advantages when it came out, and we definitely took advantage of it. And it's great that moving forward that's now permanent, unless somebody comes with a bigger, more beautiful bill.
Hopefully not, right?
Yeah. Who knows? Who knows? The world's crazy enough as it is. Or maybe he'll do a bigger, beautiful. Yeah, that's hard to say.
Yeah.
But what is another advantage that you could say that came out of it? I know there were a couple of other things that real estate investors are always talking about.
Yeah, so there's a few things, right? And there's one that's, kind of hits the individual side where a lot of frustration was around the state and local tax deduction cap. So if you were in a high tax state and you paid, say property taxes in excess of 10,000, you were always capped at the 10,000. So if you paid 20K, you were only going to be eligible for a 10K deduction. They have now increased that cap to 40K. There is an income threshold once you get above 500K income that starts to phase down the benefit. But that's a really nice one for people that had that frustration. And then outside of that, like I said, it's an extension of many things that were kind of in place. Another one, without going too much off on a tangent, was the extension of the qualified opportunity zone provision.
Oh, yes.
And so that really is a program set to incentivize investment in low income housing areas. And so there's favorable tax benefits to doing that. And so that program has been extended.
Yes, I remember it was going back and forth in these opportunity zones where they were going to expand on those and stuff. But to my knowledge, they've all kind of relatively stayed the same, and they're able to potentially expand on them later. But I wasn't altogether clear because, as far as I know, not a lot of people are taking big advantages of those.
Yeah, so some of my larger clients, kind of jumped into that early where it was just kind of part of their, investment strategy. And because, there are nuances to it. We could, go down the whole rabbit hole, but, it's a complicated structure that you need in place. So you need someone that really understands those rules. And really just the quick summary on it is the major benefit to it, as opposed to like other tax strategies, is that there is a forgiveness of your original gain. So it's really an exit gain deferral strategy, right? So you sell a property and you have a gain to recognize. It's, hey, how can I defer that gain? Investment in opportunity zone would be one of those ways. And the way it differs is the fact that you get a portion if you hold it for the set amount of time. You get a forgiveness of the original gain, a portion of it. And so there's all kinds of requirements on holding periods and things like that, and that it get nuanced. So just know that it's out there, and it's something that you could take advantage of, and make sure you talk to someone that's educated in it.
Yeah, I remember there was some type of a step down, and like the main thing that stuck out to me was like 10 years, something like that, where you would be able to realize all of the value of it. That's like CJ was saying, yeah, definitely get with your economic opportunity zone expert, because there's a lot of nuances to it, and there's a lot that can go into it to qualify for all the added benefits. I mean, we had an 8 unit that was in an economic opportunity zone, but we sold it within a year just because the gain was really high, and then rolled it into some other properties. But there are some other nuanced approaches and stuff. What would be some of the other standard things that people could take advantage of just with real estate in general as far as tax advantages?
Yeah. So I guess just starting with like, why does investing in real estate different than other investment opportunities from a tax perspective, right? So the kind of the big ones are the ability to, you use financing for real estate, you use debt, but you get to depreciate, the full purchase price less anything allocated to land, right? So, you're putting a down payment down on the asset in a lot of cases, but you're getting to depreciate the full value of that asset. So that's unique in real estate. And then, it really comes down to the magic word of depreciation, right?
Yeah.
That's really the key thing here, where the ability to have this paper loss essentially, and just to kind of break it down for those that may not understand all the nuances, right? It's essentially the value of the real estate less whatever is allocated to land. That's not depreciable, but you get to take a set amount each year of depreciation, and it's essentially a paper loss against your income for tax purposes. The reason that's nice is real estate in most cases often actually appreciates, right? So you're getting this paper loss that's lowering your tax impact, while really the asset, if you got the right deal, is appreciating. So that's just kind of why invest in real estate from a tax perspective. And then we can kind of jump into some of the strategies on the buy side, and then some of the strategies on the exit side, if that sounds good to you.
Yeah, that sounds great, because that would be really helpful to a lot of people, because it's you can make a lot of money in real estate, but you really have to have tax planning and tax strategies. There's where you come in. I mean, to where you get to actually keep a lot of the rewards, because if you do it, there's ways you can do where you can make money, but then you can make and keep a lot more if you do it right with proper tax planning.
And that's a good point, because there's a lot of confusion out there of like, a lot of people think that, they're frustrated that they're not getting that advice and that planning. And a lot of times you have to make sure that you're working with the right person, one that can do that level of planning and that's done these strategies and that's familiar with it. A lot of people are just, a preparer. They're going to prepare your return based on what happened, and they're going to be able to fulfill the compliance need that you have, which is your annual tax return. But a lot of times, we get clients that have kind of outgrown their CPA, either with, we need more of that advanced planning, where our portfolio is growing, or, hey, I've kind of been working with a generalist and that was fine for where I was at the time, but now I need someone that's really knowledgeable in real estate and these advanced strategies. So you want to make sure you get the right help for what you're doing. Yeah. So on the acquisition of real estate, the common strategy, we're talking about like 100% bonus depreciation. And a lot of times what is kind of in conjunction with that is doing a cost segregation study on a property. And really what that is doing is, a company or a person with an engineering background is going to be able to assess that property and break out certain components under different asset classes. And the whole reason that matters is that those different reclassed assets would be eligible for bonus depreciation. So just to kind of break down an example, say you bought a property for $500,000. Say a portion is allocated to land. Say that's $100,000. So $400,000 is the kind of the depreciable basis that would be eligible. If you didn't do a cost segregation, that $400,000 would be recovered depending on what type of asset you purchase, residential or commercial, 27 and a half years or 39 years. So it would be recovered over a long period of time. The cost segregation study is essentially taking that and reclassing it and basically pushing a good portion up front.
Is that based on the type of equipment and type of things you have on the property, equipment, the type of building and
Yeah, it's
fixtures and things like that?
yeah, it's based on the type of property, and the firm kind of goes in and looks at the different, kind of breaks out what's not structural in nature, and kind of puts together this report that we would then implement for tax purposes and kind of push forward that bonus depreciation. But there's tons of nuances with this, right? So that's a strategy that could work in a lot of cases, but there are some cases where it may not work. So you just want to make sure you're working with the right professional that understands your situation and can kind of help you strategize whether you should use it. Like, for example, it generally is not a great strategy if you plan on selling that property in the short term.
Yeah, because they'll have that what you call the recapture, right? When
The depreciation recapture. Yeah. Yep.
So you would have to be rolling it into another property or something else where you could recapture or capture the same. And I guess there's 1031 exchanges as well, and then
Yeah, which I was going to kind of mention here too.
yeah,
But yeah, just you want to make sure that at the end of the day, it's just you're working with someone that understands your situation, your goals, and can kind of help you, because sometimes we'll have that conversation where they'll bring it up about doing a cost segregation study, and I'll remember, hey, you mentioned to me that you don't really plan on holding that property. So maybe it's not a good idea, because then you're just going to have, a tax issue there. But, there's always a strategy for the strategy, right? If that's the issue, then, hey, let's come up with something at that point. So that's really where we try to add value in terms of from the tax planning perspective of on the buy side, and then later on the sell side as well, which we can kind of jump into.
Yeah, because I know if you're not planning, you will end up paying a lot more than you really need to. And people, I have a tough time saying a loophole when it's actually just another tax law. Really, it's there to really incentivize investors and investing, and people get all over the place where people are saying, they're, where they're taking advantage of this and not paying taxes. Well, all these real estate investors, they pay taxes. We all pay, just you probably pay a reduced federal income tax, but you're still paying property tax. You're still paying, sales tax. You're still paying, all the business taxes and all the other associated taxes with that. That's why they incentivize you to take the risk and buy the property. Yeah.
Yep. You hit it right on, right? So the tax law is written in a lot of cases to incentivize us to do certain things, right? So one of those is invest in real estate. And that's why there's very favorable tax benefits to doing so. And, just taking on that risk of investing in real estate. So that's a great point.
Yeah. So another great one that we touched on was a 1031 exchange. Explain a little bit about that for people that may not know about it.
Yeah. So that's kind of a strategy on the exit side, right? So you sell a property, you have a gain, right? Say that's the scenario. It's really a gain. It's a gain deferral strategy. So what you would do was essentially roll that the proceeds from the sale into an investment in a replacement property. So a lot of real estate investors use that to kind of trade up, right? They buy a property, appreciates, and now they're kind of rolling that into another one. And then you defer the gain. So on the sale, you would not recognize it and pay tax on it. It rolls into your new property. There's tons of requirements and nuances. So again, it's the kind of common theme of you want to make sure you're working with your advisor closely.
Definitely.
And so, there's strict time limits on it, right? So from the sale, you have 45 days to identify replacement properties, and then you have 180 days to close on that property. And then most importantly, the funds cannot go directly to you. They need to go through a qualified intermediary. and then which then goes to the investment in the new property. So those are kind of the highlights
Yeah.
of to be aware of.
Yeah, and there's, it might sound like a lot, with, 180 days, but if you don't have everything lined up, commercial property especially can take quite a bit of time to close out. And I know those opportunity zones and stuff, opportunity zone funds, people have used those in light of 1031's exchange. But again, talk to your tax advisor about that, because I know people have rolled them into those types of funds rather than using that as one of the properties that they identified. But again, talk to your tax advisor to learn more about that. But another thing I wanted to definitely touch into was that a lot of people use self-directed IRAs to invest in alternative investments. And as far as IRAs are concerned, the bulk of it is in stocks and bonds and funds and things like that. But it's not often known that you can self-direct an IRA to use that for investing in real estate. Can you explain a little bit about that?
Yeah, so we get this question a lot of, like most of the time where it's investors kind of on the early side where they're looking at what do I have in resources to invest in real estate, and it could be a good strategy of kind of tapping into another way to buy real estate. You just want to be careful of, and again, work closely with a professional, because if there's any sort of debt involved in acquiring the property, that's when there becomes potentially adverse tax implications and kind of a nuanced calculation around it.
Okay.
So if it's in a case where you're buying the property with no debt, it could work pretty seamlessly. But in the case that there's debt involved is where the kind of nuances come in. And then just, keep in mind that your self-directed IRA would own the asset. So the rental income and everything just goes in there. So you'd be still held to like those requirements.
Yeah. Yeah, and I guess there's that clause that says like self-dealing and stuff. So say for instance, like you were looking to buy a property or invest in one, you could you put your money as from your self-directed IRA in the property and sign on the debt personally? That would probably be like, could that be kind of considered a misdealing?
You would run into some issues there.
Yeah,
So yeah, what I would say is it's overall, it could be a good tool to kind of tap into, but it would just take some conversation around your situation. What are your specific
yeah,
resources? What are you looking to acquire, and kind of assessing the options. So it works in a lot of cases, but it's generally where there's a good amount in your IRA to kind of invest there, and where assessing how much debt is going to be involved, and kind of running the numbers on what's the, are there any adverse tax implications from doing it?
yeah. And I guess you have to look at the nuanced strategy and what's optimal for the money that's in there. And you want to make sure you're not doing any self-dealing and stuff, because if you are directly benefiting from something, that's what they mean by self-dealing, because you don't really want to be, if you are directly benefiting, like if you close on the property and you're getting a commission from that property and signing on the debt and using your self-directed IRA, it'd be kind of obvious to the IRS that you're benefiting, you're getting the commission, you're signing on the debt, and you're also getting the equity and stuff. So, but that would probably be one case where you would definitely want to find something else to do with the money, because it would be you would definitely lose all those tax advantages from using the self-directed IRA, whether it's a Roth or a non-Roth IRA. But going forward, what do you see like becoming, because of these tax strategies and these the big beautiful bill? What do you see going forward? Do you see these benefits really creating more transactions? Do you see going forward people using them a lot more?
Yeah, so I can tell you we since that has passed, we've gotten a lot of activity on the planning side, a lot of clients reaching out, prospects reaching out, and that really unlocked a lot more. It made everything that you could do before a lot more powerful. So I think it will really incentivize real estate acquisition as part of their strategy. But I do like to always mention that you don't want to chase the tax benefits
Mhm.
first, right? You got to make sure that a deal stands on its own merits, that it makes sense for as part of your investment strategy, and then have the tax benefits be the icing on the cake.
Yeah.
Because you don't want to just chase a bad deal, reap
Yeah.
the tax benefits, be nearsighted, and then find hey, I'm kind of holding this bad deal now.
Yeah, you definitely want to make sure the property is cash flowing, making money, and then, like you said, the tax benefits are the icing on the cake. You don't want to do it the other way. If you're not really making any money, you don't necessarily need the tax benefits because you probably won't. If you're not making any money, you're not paying any taxes.
Yeah, that and just really understanding like how the tax benefits impact you. There's a lot of confusion around that. I don't know
Hmm.
how deep you want to go down that discussion, but whether you're a real estate professional and how your losses are treated, there's a lot of
Yeah.
confusion around that. Happy to bring some.
Yeah, let's expand a little bit on that. Like, what is considered a real estate professional, and let's expand on that because a lot of people there are additional benefits from being a real estate professional and not being a professional real estate investor. There's a big difference there.
Yeah, yep. So in previous tax law, there was these things called the passive loss limitation rules that kind of entered, and what that did was prevent really high income earners that were just investing in real estate and using all the losses against their income and paying no tax. So what they did was they introduced these rules that made it a little bit more difficult to do that. So essentially, there's different buckets of the way activities are considered, right? Passive or active. So in order for your real estate activity to be deemed active, you would need to be considered a real estate professional, which is you spend at least 750 hours during the year in real estate activities. Um, and this is what gets a lot of people is you have to spend more time in real estate than any other activity. So that's when W-2 earners start to
Yeah.
hit a roadblock. It's just that a lot of people seek to chase, hey, how can I use real estate losses against like my active W-2, my active business? And if that's what the chase is, that's where you can run into issues. Now,
Yeah.
again, there's always some caveats in planning, right? We have a lot of clients who maybe they're the high income earner and they have a business or a W-2, but their spouse can qualify as a real estate professional.
Yes.
If you file jointly, then in a lot of cases you can combine that together and reap the benefits. So that's just kind of one thought there. And then just to keep in mind that even if you are deemed passive and you can't offset, active income, it's still really a tax efficient way to invest, right?
Hmm.
You're still going to get the depreciation that offsets the rental income. Maybe it's not going to offset your W-2, but you're still getting your rental income shielded from tax with depreciation. And then in the case that a property is sold, in most cases, it's going to be taxed at a more preferential rate, right, as capital gains rate as opposed to ordinary income tax. So it's still a very tax efficient way. It's just the question we get is like, how can I write off real estate against my W-2?
Yeah, and that's where people get into problems. Where I've seen people's advantages, where you touched on was, where, say, for instance, one of your wife or husband they do real estate and you keep the W-2 maybe for the benefits and everything else, and then they do everything in real estate. And it's pretty easy to rack up 750 hours if you're an active real estate investor. And then it also, your point, has to be more than you do anything else. So you can't have, if you do have something that's part-time, you have to make sure that you're doing that. And and it's been one of those things where you really have to keep going over your strategy as you grow, and as your strategies change, your tax strategy is going to change as well. Like what I needed 5 years ago is vastly different than what I need right now. So make sure you have somebody. I've heard people like hem and haw about, well, they're charging me $2,500 for this and that and whatever, but they could be saving you 100,000 or 50,000 if it just by one or two different boxes, or different amounts in the in your tax filings. So don't underestimate the advantage of all these tax advantages there are. Seek out your professionals and stuff, because it's the same reason why you seek out real estate professionals that you want to learn from the tax professionals. And this has been really great. For people that need to find out more about you and all your tax advantages and stuff, and want to learn more from you, where do they find you?
Yeah, so on social media platforms, that's CJ the CPA. You can find me there. On Instagram, we post a lot of content. You can also get some of our resources there that we provide for free. Also, our process is, if you want to become a client of ours or see if we're a good fit, we do an initial call just to get an idea of your situation. We'll add some value there of just maybe some key insights that you should be thinking about. But really the goal is to assess, are we a good fit to work together? Can we add value to your business, your situation? And then from there, we would kind of lay out the roadmap of what it would look like to work together. And really, the key for us is, like you said, we will meet with you throughout the year to kind of build out that plan, tie up any loose ends, make sure we understand all the nuances, and the goal is making sure that everything's efficient and optimized from a tax standpoint, whether that be entity structure or different strategies you should be thinking about.
That's really great. I mean, if you guys want to find out more, just contact CJ. He's the real estate CPA, and it's really been great. And I really appreciate you taking the time and explaining and just putting in plain language so that everybody can understand. So definitely get in touch with him, because everybody needs good tax planning when you're a real estate investor.
Thanks, Scott. Appreciate it.
You're welcome. This is Scott Kidd. I'm the Yacht Captain Investor. And this is a reminder that the best investment you can make is the investment that you make in yourself. Thanks again, guys. And we'll talk to you guys soon. Thank you.